Okay guys, the last part of the puzzle where inventory is concerned, we are going to do manufacturing. Manufacturing is also part of inventory. And before you actually continue with the rest of this video, please do yourself a favor, follow this link and watch this video first. Now, that's only a 3-minute video. It is very interesting. It is the tire manufacturing process of Michelin tires. It is really, really interesting, and I'm going to refer to that production process in this video as we go along. So do yourself a favor, quickly copy this link and quickly go and have a look at that manufacturing process. Now, what do we want to achieve by doing this module? Number one, we want to understand what is meant by manufacturing and the flow of the process. Number one, we had the rubber sheets. And then we added to the rubber sheets some steel wire, some textiles, etc., etc. And then there was a whole process that took place in order to convert this raw material into the final product, which is the Michelin tire. So that is what we mean by the flow of the process. Where do I start in order to achieve my end result? And my end result is going to be the finished product. Now, that very same process we also follow in our accounting records. So we were going to record the flow of the manufacturing process. First, I'm going to issue the rubber sheets. How am I going to account for that? Then I'm going to add the steel wire. How am I going to account for that? Who's going to add the steel wire? Who is responsible? Who is going to be involved directly with doing the things that's needed in order to manufacture the tire? That is my direct labor. And what other costs are needed in order to convert this raw material, this rubber sheets, into the final product, which is the Michelin tire at the end of the day? So our general ledger also follows the process that has been followed by the manufacturing, the factory, in order to manufacture the final and the finished product. So it is including the raw material. What am I going to do about raw material? How much was issued? That is what I'm interested in. How much of the raw material in our stores was actually issued to the factory, to the production process? What was the cost involving the direct laborers that's working on the floor? And what is all the other costs that I had to incur in order to make this production process work? Then I want to prepare the work in progress and finished goods and cost of sales accounts. Now, what now? Here, we're going to produce and we're going to work out what was the actual manufacturing cost of a finished product. Once we finish the product, we're going to transfer that to the sales department. What happens in the sales department? There we had finished products to start off with, our opening inventory finished goods. We have received goods from the factory at a certain cost, and at the end of the day, we still have some of that finished goods on hand. So opening inventory, plus the goods, the cost of the goods that we've received out of the factory, less our closing inventory. What is that? Our balancing figure being cost of sales. Think about your inventory account. Looks exactly the same. Opening inventory, not cost of purchases now because we didn't purchase, but cost of manufacturing now. That replaces the cost of purchase. Less closing inventory. So what is the other balancing figure that we're looking for at the credit side of the inventory account? Cost of sales. The cost of sales of finished goods. And then there is the one that doesn't smell that nice, unrealized profit. I will explain to you what do we mean by unrealized profit and how does unrealized profits affect this flow of transactions that we have to record in our financial records. Now IS2, the statement that's all about inventory, says, well, what is the cost of an inventory item? It's the cost of the purchase of what? Of the raw material. So remember, we're going to convert something in a raw material format. Here we had rubber sheets. The rubber sheets doesn't mean anything, but the final tire means quite a lot. So what was the cost price of those raw materials that we had to purchase, which we have to convert? What was the cost of conversion? What did we convert? The raw material. Into what? Into the final product. And then all the other costs that we had to spend in order to get that product to its present location. That is where I'm able to sell that product. and in the condition to enable us to sell that same product to the general public. So what is all the other costs that was involved in order to make sure that we finalize this production process of the tires, and which will enable us to transfer that tire to our sales department, who can then on their side sell the tire to the public or to whoever they're going to sell the product to. Now, our cost of manufacturing, and that's also an IS2, is obviously the cost of raw material. The cost of direct labor, that is the guys who's directly involved in some part of the production process. And then the overhead cost is all the other costs that I have to incur in order to make and to finalize this production process. Like what, you can ask? Well, I need, number one, some premises where I can actually do this production process. So I need a factory. Do I own the factory? Do I rent the factory premises? If I rent it, it's an overhead cost because of the cost that I have to involve. I have to put my machines down somewhere, so that's an overhead cost. We're going to talk about overheads a little bit later some more. Good. Now, ACCC, we said, is all about the disclosure of items. So IS2 says in the statement of financial position, you know by now that we have an inventory note. And in the inventory note, you only used to have inventory, trading inventory, which is in essence our finished goods, and consumable inventory, which is things like stationery or fuel or something like that, something that I use. Now we have expanded our inventory note to include raw material on hand. Guys, I have paid for that raw material. I have that raw material. I'm going to use that raw material. So if there's still inventory on hand, that inventory on hand at the end of the financial period will now become part of my inventory figure in the statement of financial position. Work in process. Now, what is work in process? That is goods. If we think about the tire process, that is still on the factory floor at year end. I've already started with that process, but those tires is not finished as yet, so I couldn't transfer it as yet to my sales department. So there is still cost that I have to incur in order to complete the process of the manufacturing. All the costs that I've already incurred up to the stage of completion at year end of that tire, all those costs are accumulated, and that forms part of the cost price of the work in process at the end of the financial period. And that is, it is not a completed product, it's a half-completed product, but that half-completed product, the value of that must also be included in our inventory note, because that is also inventory at the end of the year. Now, do you still remember our good friend net realizable value? What does net realizable value mean? This is on each and every class of inventory item that I have on year end. I have to perform the net realizable value test. Now, there's an interesting phenomenon in this test. It says when I do perform the net realizable value test in a manufacturing environment, and the NRV of my raw material is lower than the cost price of my raw material, but my NRV of my finished goods is much higher than the cost price of the finished goods, I do not have to adjust my raw material cost to the NRV of the raw material. Why? It says because once that raw material is converted into a finished product, then that finished product's cost is much lower than the net realizable value. And that raw material is only one component of the finished cost of a finished product. So for that reason, in that case, I do not have to write down my raw material class item to NRV. I say again, provided that my finished goods cost price is much lower than the NRV of my finished goods. Remember that, please. Right, now what is material? Now, if you think about the tire manufacturing process, the main component in tires is rubber. Where does rubber come from, guys? It comes from rubber plantations, and they actually milk the trees to get the rubber out of the trees, and then they catch it up and then they export that, and that is the main component of rubber. They add a few chemical products to the rubber. They add some textile to the rubber, some material to the rubber to give that elasticity. I can't say that word. Elasticity in order to make the tire work properly. And then they also add steel wire and things like that to strengthen the tire. But the main component being the rubber plus then the others. Now, let's say we were making shirts. We were a dressmaking kind of entity and we make shirts. Now, what is the main component of a shirt? That is the material from which the shirt is being made. But I need some thread in order to sew that raw material in some kind of format to make the shirt. Now, because the shirt, the material, makes up about 98–99% of the total component cost of the shirt, and the thread is only a very small portion of the cost, let's say 2% at the utmost. So that thread that I'm using in order to make the shirt won't form part of direct material. That thread, it's necessary, yes, but because it's such a small component of the total cost of the finished product, that will then be classified as part of indirect material, and indirect material forms part of overhead cost. So this direct material that we're talking about here is really the main components which is needed in order to manufacture the finished product that we're looking at the end of the day. Direct labor. Now guys, that is the guys who is directly involved on the floor of the factory at some stages of the manufacturing process. This guy, for instance, he stands here the whole day. The tires up to this after they've completed the process thus far, comes there on a conveyor belt. He checks the tires as it moves past him. Does it adhere to the quality standards? Does it look all right? Isn't there any problems? Blah, 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 blah. So he stands there for the whole day. He is assigned to a portion of the production process, and he can actually touches that portion of the production process in which he is involved at. And for that reason, we classify him as part of direct labor. Now, an easy test is those laborers who actually touches a part of the production process. He's not here and there and everywhere on the floor. He is assigned to a certain part of the production process, and he's involved to make sure that everything runs smoothly in that part that he's involved in. So he's directly involved in the production. Now, factory overheads, that is all the other costs needed in the conversion process. How to convert that raw material item into the final tire or final product that I'm actually manufacturing. It's not easy to allocate these kind of costs to a specific stage in the production process. Think about the rent that I pay for my factory premises. I cannot assign that to a portion of the production process. It is needed for the whole production process. The salary of the factory manager. He's not only looking at one part of the production process. His job is to make sure that the whole production process runs smoothly and that all problems are being sorted out. The same thing applies to the guys who's cleaning the factory premises. They're not only cleaning that little corner, they clean the whole factory. So electricity. That doesn't only apply to this portion of the production process, it applies to the full production process. So all those costs are very necessary in order to make this production process happen, but we cannot easily allocate them to certain units or certain parts of the production process, although they are directly linked to the production process, and we accumulate all these kind of costs and in our overheads calculation or our overheads accounting general ledger account. Now, here's examples once more. Depreciation, guys. If I have machinery on my floor, I have to depreciate that machinery. That machinery, that depreciation does not form part of my normal operating cost anymore because it's not an operating cost. That is a direct cost of manufacturing. And cost of manufacturing is all accumulated to determine the cost price of the item that I've manufactured. So therefore, depreciation on machinery in my factory environment That will then form part of my overhead cost. My overhead cost forms part of the cost price of the goods that I've manufactured. So the cost price of the goods that I'm eventually going to sell. However, if I have depreciation on a delivery vehicle, the delivery vehicle has got absolutely nothing to do with my production process. And therefore, the depreciation on the delivery vehicle will still be a normal operating expense. So obviously, here you have to distinguish between what costs are needed in order to make the production process happen, and that will then form part of my overhead cost. And all the other costs that's not needed to make the production process happen, that will still be in my income statement shown as an operating expense. So if I pay rent, for instance, the rent that I pay for the factory premises where the production process takes place, that portion of the rent will then form part of my overheads. But the portion of the rent that I pay for my sales department, that's got absolutely nothing to do with the production process. So the rent that I'm going to pay for the sales department, that would be a normal operating expense. So here you have to go and look at all the expenses that was incurred by the entity, and those expenses that is directly attributable to the production process is going to be form part of your overhead cost, and the other expenses is going to be still a normal operating expense. Things like consumable goods like oil. I need some oil in lubricants to make this machines run smoothly. So if I need lubricants on a general basis, then that lubricants or oil, whatever, that is going to be a part of my overhead cost. Floor supervisor, he's very much needed to make this whole process happen, and therefore his salary and everything, all the costs associated with him, that will form part of overheads and not part of salaries and wages in the income statement, which is classified as operating expenses. Now, what is conversion cost? Listen to the word conversion. That means I have to convert something in something else. What am I converting? I'm converting raw material. In the case of our tire manufacturing, I had this rubber sheets. I have to convert a rubber sheet that looks like this, just a flat sheet. I want a tire out of it. So I'm not going to get a tire out of that. By applying direct labor, they're going to be involved there, they're going to pick up the sheets, they're going to put it into the machine, they're going to make sure that whatever happens thereafter happens, when it has to happen and how it should happen, as well as all my overhead costs in order to make this happen. So what do I convert? I convert my raw material. So what is my conversion cost? My direct labor and my overhead, all the costs that I incur in order to convert the raw material into my final product. What is my primary cost? Guys, just the word primary cost. What does primary means? Most important. Number one, direct material and direct labor. That is my primary cost. Without direct material, nothing can happen. I don't have a production process. Without direct labor, not much is going to happen with my direct material because nobody is going to look after the conversion of my direct material. Now, if you're going to have a look and think about it logically, if you have to put it on a diagram like this, we need raw material, which is coming from the rubber trees. We need direct labor, who is actually working directly with these guys. And then we have manufacturing overheads. And manufacturing overheads is all the additional costs that I'm going to incur in order to make this thing happen. Now, raw material issued plus direct labor paid plus manufacturing overheads, that all happens on the factory floor. So that is all work in process. As soon as I've issued raw material, it becomes part of my work in process. I'm going to apply labor and I'm going to incur other costs and I'm going to convert this raw material into a finished product. So after it has run through the whole process, it comes to an end where my working process has been completed, and then I'm going to transfer that completed product to my sales department, my finished goods, to enable my sales department to sell that product. So if you think about an accounting perspective, direct material, what do we get in any inventory account? It doesn't matter whether it's direct material or whatever. Any inventory account, what did we used to have on the debit side? Opening inventory plus purchases less closing inventory. And what was then the balancing figure? Cost of sales. Now we're not going to sell the direct material. What are we going to do? We're going to issue the direct material to my factory environment where it becomes work in process. So therefore, opening balance plus the purchases and the purchase related cost of raw material less my closing inventory of raw material is going to be equal to the material that I've used, material that I've issued into my production area, and my production area we call in accounting terms work in process. Direct labor, all the costs that I've paid, all the direct labor costs that I've paid, plus any amounts that I still owe at the end of the financial period. So all the amounts that I had to pay for my laborers for that specific financial period, that will be accumulated in my direct labor account. And obviously at the end of the period, I'm going to transfer that to my work in process. The direct laborers only is involved in my production process, so all the amounts payable to them will be capitalized eventually as part of the cost price of the goods manufactured. My overhead costs. Now here I'm going to accumulate all my overheads, things like depreciation and machinery, electricity, indirect material used. Again, it's not open or purchased or whatever. I'm interested in how much have I issued into the production process. Indirect labor cost and all other indirect charges, I'm going to accumulate that all in the overhead account, and at the end of the period I'm going to transfer all those costs to work in process. Remember what I've said in the beginning, work in process is raw material, direct labor and manufacturing overheads. Everything issued to the factory floor up to the point of completion where it's been transferred to my finished products, my sales department. Right, once I have completed then my work in process, what is happening then? You said, well, work in process is then going to be my material issued, my direct labor costs incurred, all my overheads incurred, less my closing balance of work in process. Now, what is opening balance work in process and closing balance work in process? Now, that is my items that was not 100% completed in the beginning of the process and items which was not 100% completed at the end of the process. So this tire manufacturing, here's my finished product. There it is, all the finished tires in the store. So I'm not there yet. Some of the items is already been issued up to my factory floor, and it is only partially completed, either in the beginning of the year, and then obviously I have completed it during the course of the year, or at the end of the year I have semi-completed goods still on my factory floor, which has not been transferred to my finished goods store as yet. Now that work in process, that is where that closing balance, that is the value of that work in process, that will be shown as an inventory item, my statement of financial position. Good. In our finished goods, that is now when a product is 100% completed and transferred from the factory floor into our sales department. And that is our finished goods. Finished goods is exactly what you are used to. The only difference is you're going to have an opening inventory of finished goods like you've always had. You will not have purchases of goods because you haven't purchased the goods, you have manufactured the goods. So what you're going to replace purchases with is the cost of finished goods transferred. The cost, the production cost of finished goods transferred. So that is going to add that, and then you will have closing inventory of your finished goods. Now think about your T account. T account inventory. Opening inventory, tick. Purchases, we said we're going to replace now with the cost of finished goods manufactured. That is coming from the work in process account, tick. On the credit side, we're going to have closing inventory. And what is the other entry on the credit side that we need? Cost of sales. So that is still exactly the same cost of sales. Guys, just thinking about this, we have now quite a number of inventory items. Now, your normal inventory valuation methodology also applies here. My direct material can be on first in, first out. My finished goods can be weighted average. So you must also be able to link your inventory valuation methods to manufacturing. The principles are exactly the same. Right, now here we get to the new stuff, what manufacturing is all about. You did a little bit of manufacturing at school, not that you understood what you've done, but now we're going to do something a little bit that you haven't done before, a little bit more, and that is unrealized profit. Let me explain to you where it comes from. In our manufacturing area, in the factory in other words, there's a lot of effort that's being put into manufacturing a high quality product. That high quality product is being transferred to the sales department to sell it to the outside public or to the retailers, wholesalers, whoever they're going to sell to. Now, if these guys in the factory doesn't do a good job, who is going to pick up the slack? The sales department. The sales department is going to have all the comebacks from the customers. The product is inferior, the product doesn't have enough quality checks and controls and balances and what have you. And so they're going to pick up a lot of nonsense. But on the other hand, if they're going to sell a very good quality product, who is going to make all the profits? It seems as if we have a wonderful sales department, and then they are going to walk away with a lot of satisfied customers, that's satisfied with the products they're going to buy, and it's going to look as if they are going to perform extremely well. Now, in a lot of environments, the factory guys said, this is not fair. If you are going to sell the product, the profit on the sale of the product is going to be allocated to the sales department. But come to think about that, if it wasn't for us, there wouldn't have been a product in the first place. And if it was for us, where all the quality checks and controls are in place, you wouldn't have a quality product in order to sell so that you have a good name in the marketplace. So therefore, we want a bit of this profit allocated to us. So let's assume that a product costed 100 Rand, and then the sales department sells it outside for 120 Rand. Now it is clear that the net profit is 20 Rand. And that net profit of 20 Rand used to be allocated to the sales department. Now, a lot of entities have said, okay, we recognize that fact, and we want to encourage you to keep on manufacturing such good and well and high quality products. So therefore, when you transfer the product from work in process, from the factory, in other words, to the sales department, you are allowed to add a 10% profit to the cost price of that product. And in other words, when the sales department receives that product, he's not going to receive that product at 100 Rand, the actual cost price. He's going to receive that product at 110 Rand. The sales department doesn't even know what the actual cost price is. According to them, the cost price was 110 Rand. Now, they're still going to sell the product for 120 Rand because there's a lot of market factors that comes into play when I determine selling prices. So they can only sell it for 120 Rand. So what does it mean? They realize then with the sales transaction a 10 Rand profit. But what was the actual profit of this sale? The actual profit was 20 Rand, 120 less 100. The first 10 Rand, 10% of the 100, was actually taken by the factory at the date of transfer of the finished products to the sales department. And there they said they've made their 10%, their 10 Rand profit. Now, it is all fair and well if this product was actually sold into the marketplace, because here we can clearly see if we sold the product for 120 Rand, 10 Rand profit is recognized by the factory, and 10 Rand profit is recognized by the sales department, so 10 plus 10 equals 20, and the actual profit is in any event 20. So what is your problem? Yeah. The problem is not when a product has been sold, because then this profit of 10% was realized, and this profit of 10% was realized. So what does realized mean? It means it was converted into cash. So therefore, that is not a problem. But what happens at year end, that if this factory environment has transferred some of the products to the sales department, but at year end those products has not yet been sold. When they transfer the product, they recognize 10% profit. But have they made a profit in actual fact if that product hasn't been sold? No. So this 10% is an unrealized profit up to the date when the actual sales to the outside world takes place. Therefore, if there's still of this 10% unrealized profits around at year end, we, out of an accounting perspective, must eliminate that because we cannot recognize profits that has not been realized in our books. Thinking also what I've said here is that the sales department assume that the cost price of the product that they receive from the factory is 110, not 100. Is that factually correct? No, it isn't. Because the actual cost price is 100 Rand. Let's say that they have on hand all those products at year end. Still, they haven't sold them. At what value are they going to show these products? They're going to show the products at 110. But is that the actual value? No, it isn't. The actual cost price of that product is 100. So at year end, for the inventory that's still on hand at year end, which hasn't been sold, in other words, we have to remove out of the accounting records the unrealized profit included in the closing inventory, because we are only allowed, according to IS2, to show inventory at the lower of cost or net realizable value. The cost isn't 110. The cost equals 100. So you will see that we are going to create then an allowance for unrealized profit of 10 Rand. We're going to show inventory then at the value in our finished goods account of 110, less our allowance for unrealized profit of 10, which is going to give us 100 Rand then net. And in our statement of financial position, we are only going to show the 100 Rand. Good. Now let me show you how it works then in practice. Let's do a few exercises first. Let's assume that raw material of 100,000 Rand was issued to the factory. Direct labor paid was 30,000. The supervisor's salary was 4,000. Electricity was 3,000. Lubricants for the machinery was 1,000. And rent paid for the factory was 5,000. Let's do number 2 first. How much is the manufacturing cost of the products in the example? Now pause the video and quickly do the example. How much was the total manufacturing cost? Because it's obviously the raw material of 100,000, direct labor of 30,000, and then my overheads. 4,000 plus 3,000 plus 1,000 plus 5,000. And once I've done that all, it gives us then a total of 143,000. Raw material, direct labor, and here's all our overhead costs, which then in total gives us a total of 13,000 Rand. The first question was, how much is the conversion cost? Now remember, conversion cost is the cost that I've incurred in order to convert the raw material into the final product. So it cannot include the raw material, but it's a cost incurred to convert the raw material. So that's my direct labor plus my overhead costs. So that is in total then 43,000 Rand. Number 3. Suppose that work in process, so incomplete products at the beginning of the period was 6,000 Rand, so I've completed it now. And work in process, i.e. incomplete products at the end of the period was 9,000 Rand, so it's already on the production floor, but the final tire hasn't been produced as yet. What is the value of the finished goods transferred to the sales department? So what is the cost involved of the goods that I've completed for the period? Now, I had 6,000 in the beginning of the period, which I've completed now. The cost of goods that I've manufactured during the period was 143,000, but of that 143,000, 9,000 Rand is still incomplete product, so I have to deduct that again. So that means that in total, the cost of finished goods completed was 140,000 for this period. Suppose the production department decide to add a 10% profit to the cost price of finished goods when it is transferred to the sales department. At what value will the finished goods be transferred to the sales department? Now remember, work in process is in the factory area. Work in process is all about the actual cost, the actual production cost. So the actual production cost was 140,000 of finished goods. Then they transferred it to the sales department and then they added a 10% unrealized profit. So they've transferred it at the actual cost of finished goods of 140,000 plus 10%. So in other words, multiplied by 1.10, and that is a cost of 154,000. How much out of the accounting perspective could they took out of the work in process account? And remember, the work in process account is just an accumulation of the actual cost. So the max that they could have taken out of work in process is 140,000. So that additional 14,000, 154 less 140,000, that 14,000, that obviously would have been in my finished goods account, but it cannot be in my work in process account. So the counter leg of that, what is the 14,000? That is unrealized profit. So the counter leg is I'm going to debit my finished goods account with a 14,000, and I'm going to credit an unrealized profit account, profit and loss account, with a 14,000. Is that 14,000 already a realized profit? No, because it has not yet been converted into cash in the bank account. So when will it then be a realized profit? Once it's sold. Now, so we say that for our closing and our opening inventory of finished goods, that both of them will complete a component of unrealized profit. The finished goods account lies in the sales department. According to the sales department, the cost price of these goods that they've received was 154,000. We know it wasn't. But then when they're going to value their opening inventory and their closing inventory, that is also going to be a blown up figure with a 10% unrealized profit included. Therefore, think about an inventory account. Opening inventory will have an unrealized component. Cost of finished goods will have an unrealized profit component. On the credit side, closing inventory will have an unrealized profit component. What is the other entry on the credit side of an inventory account? Cost of sales. And cost of sales now will also be a blown up amount because it's based on those costs that we have spoken about. Opening inventory, cost of goods received, and then closing inventory. So therefore, it also means that we are not only going to eliminate the unrealized profit in our closing inventory and opening inventory, and for that we need an allowance for unrealized profit, the statement of financial position account. We are also then going to have to adjust our cost of sales for the year so that we take out the unrealized profit which is still lying in cost of sales. So cost of sales, when we talk about unrealized profit, cost of sales, opening stock in my finished goods, my manufacturing cost, and my closing stock of finished goods, all of them includes an unrealized profit component. So therefore, cost of sales also has an unrealized component. For us, I will show you in a little while how we're going, in an example, how we're going to determine that unrealized profit and cost of sales. So, for statement of financial position purposes, we have to show finished goods at the lower of cost or net realizable value. So the cost price of our finished goods will then be the value or the closing balance as in my finished goods account, my general ledger account, less the allowance for unrealized profit in my allowance for unrealized profit account. So that allowance for unrealized profit works like an allowance for credit losses, for instance. It's a negative asset. The purpose of that is to bring the inventory value down to the cost price, the actual cost price of the inventory on hand as at year end. So our allowance for unrealized profit, the opening balance, that will be realized during the year. So that's going to be transferred to cost of sales because that's realized. The closing balance of my allowance account, that is not yet been sold. That is our inventory that's still on our books, which hasn't been sold. So because it hasn't been sold, hasn't been converted into cash yet, and therefore that profit is still unrealized. So our closing balance of our allowance for unrealized profit will be equal to the unrealized profit included in our closing inventory of finished goods. Let's look at the flow of transactions, and in the first example we're going to ignore unrealized profit. We're going to look at how does it look when there's no unrealized profit involved. In our raw material account, we're going to have opening balance of raw material plus all purchases plus purchase related cost, and we're going to have our closing balance of raw material, and that 250,000 obviously is going to go to our statement of financial position, and that is going to be the value of raw material on hand at the end of the year, 250,000. The balancing figure here, what does that entail? What does it actually represent? Opening balance plus purchases less closing inventory equals, when it is a normal retail item that I've sold, it would have been cost of sales. So now it's not cost of sales, it will be the cost price of the material issued to the factory. So that is what I'm after. What was the cost price of the material issued to the factory? Remember, if material is still lying in the stores, it's not on the production floor, therefore those that's still lying in the stores cannot form part of the cost price of the goods that I manufactured. I haven't used it as yet. So I'm really after the amount of material used, issued to the factory environment, which is in this case 410,700. So I credit this account and I will debit my work in process account, 410,700. Now this pinkish reddish line here, everything on that side of the line, so this whole page plus everything up to there, that is happening in the factory environment. Anything below this line, that is happening in the sales department. Good. Direct labor, we've paid 178,000, and that is the amount that we transfer to work in process. So work in process there, direct labor, 178,260. In our overhead accounts, we're going to here accumulate all our overhead costs, indirect labor, indirect material, maintenance costs, sundry costs, electricity, depreciation, rent paid for the factory, etc. And once we've accumulated that all, we're going to transfer the full amount to our work in process account, 552,280. So here, 552,280. Work in process. We say, well, in the beginning of the period, we had incomplete products. We were still busy in completing that products, and the value of that products up to that stage was 285,400. At the end of the day, we still have incomplete products. We're still busy. We haven't completed products with a value of 326,400. So therefore, our balancing figure here on the credit side, what does that represent? The cost price of goods completed during this financial period. So that goes to our finished goods account. Again, can you see now why we cannot add here any unrealized profits? Then this thing is not going to balance. What are you going to add? The 1.1 million rand is the actual cost. You can see there's all the actual costs. So that's the actual cost of manufacturing. So we're going to transfer the 1.1 million out of that account into our finished goods account. Right. Now there's no unrealized profit in this first example. So therefore the cost of our opening inventory finished goods plus the cost price of the finished goods completed during the period less our closing balance, those products that we haven't sold as yet, that gives us normal cost of sales like in any normal inventory account. Cost of sales 105,240. Our cost of sales, that goes to the cost of sales account. At the end of the period, the cost of sales account is being written or closed off against the trading account. So cost of sales would have been credited, trading account would have been debited with a 105,240. Sales would have been on the credit side there of 2.5 million. Oopsie. Sales of 2.5 million. And then we would have, the balancing figure would have been our gross profit, which we're going to transfer to our profit and loss account. Right, now let's take this very same example and we say when we actually transfer the goods from the factory to the sales department, we're going to add a 10% unrealized profit. What is now different? Now guys, Does that have an effect on my raw material cost issued? No, this stays exactly the same. Does it have effect on my direct labor expense account? No, that stays exactly the same. Does it have an impact on our overhead cost? No, it stays exactly the same. So therefore, because that all stays the same, can it possibly have an impact in my work in process account? No, it can't, because what is the purpose of my work in process account? To go and determine the cost price, the actual cost price of goods manufactured and completed in the current financial period. So I cannot post anything else yet than the cost of the goods manufactured, and that I transfer to my sales department. So there it is, 1.1 million. But the sales department don't see the 1.1 million. They see an inflated figure of 10%. So unrealized profit, if we assume it was 10%, 10% of that 1.1 million gives us 110,000. So we're going to debit our finished goods account with 110,000, and the credit leg will go to our unrealized profit and loss account, which is a P&L account, and there it is, 110,024. That was my unrealized profit on what? On goods manufactured during the year. Now, that's not to say that I've sold those goods during the year. If we go back to our finished goods, we had an opening balance of 340,000. Now, guys, can you see, because I'm going to pass the unrealized profit into this account, when I transfer the goods, that will mean when the sales department is going to do a stock take, they don't know that there's a 10% unrealized profit component included in the value of the stock on hand. Therefore, our opening inventory there of 340,000 would have included the unrealized profit component. Last year, we had to compile our statement of financial position, and therefore we had to take out the unrealized profit included in that amount out of the books. And for that purpose, we had an allowance for unrealized profit based on the 340,000. So the 340,000 includes a 10% unrealized profit. So when we take out the unrealized profit, 340,000 times 10 divided by 110, we would have had an opening balance on our allowance for unrealized profit of 3909. So last year we would have shown inventory in our statement of financial position of 340,000 less 3909, and only the net amount would have appeared in the inventory note in our statement of financial position. Now this 3909, that was the unrealized profit in opening inventory, which I hope so have sold during the year. So that 3909 we're going to transfer to our P&L account because it was sold during the year, 3909, and there it is. The unrealized profit in the opening inventory we transfer to a profit and loss account. Now, at the end of the year, we still have 390,000 Rand of inventory on hand, but that is an inflated figure. So at the end of the year, here we've taken out the opening balance, we have to recreate the allowance account at 10% included in the 390,000. So 390,000 times 10 divided by 110 gives us 35,455. So we're going to create the allowance account again. Remember, when I bring down the 390,000, it's going to be on that side. Let's write it here, balance. Go down. And that gives us a total of 390,000. So what are we going to show in our statement of financial position? 390,000 less 35,455. In order to create this allowance, what do we have to do? We're going to debit the unrealized P&L account. Remember what is lying in this P&L unrealized account? Our opening balance, which we have realized, our cost of goods that we have transferred. Now the cost of goods that we have transferred during the year of finished goods was 110024. But included in that 110024, or in that total amount if you want there, is still 390,000 on hand. So obviously we haven't realized that full 110,024. So the portion that we've not realized is the unrealized profit included in the closing inventory. So therefore, we're going to take that out of the closing inventory and we're going to pass that to the allowance account. So what is left in our unrealized P&L account? Now think about that now, it makes sense. Unrealized profit in the opening inventory plus unrealized profit in the cost of goods that we have transferred from the factory environment, less unrealized profit at the end of the day in the closing inventory. And what is that? Opening inventory plus manufactured less closing inventory, cost of sales. So that balancing figure there is going to go to my cost of sales account. What is now going to lie in my cost of sales account? There is a credit entry, so the debit entry is in cost of sales 1160,264. This is a debit entry, so the credit entry is going to lie in my cost of sales account 105,478. So what is my total cost of sales for the year? 1160,264 less 105,478. And that is what you're going to show in your statement of profit or loss as cost of sales. Sales is going to be determined as always. So sales less cost of sales is going to be gross profit. And from there on further, you're back to normal again. Right. So have we achieved what we wanted to achieve? Do you know what is meant by manufacturing and the flow of the process? Can you record the flow of the manufacturing process in the general ledger, including raw material, direct labor, and overheads? Can you prepare the work in progress account? Can you prepare the finished goods and the cost of sales accounts? And can you calculate and record unrealized profit? Guys, manufacturing is actually very nice to do. It's if you understand the flow and you understand this whole principle of unrealized profit, it is really not difficult and I really cannot catch you out.